Today we are just going to cover Chapter 12, Reporting and Interpreting the Statement of Cash Flows. Actually, we are not going to cover the whole chapter, rather just the introduction. Another lecture will follow to cover the practical part of it. So the objective of this class is to understand the need of a statement of cash flow and what are the main difference between accrual and cash basis accounting, and then we would introduce the statement of cash flow to know what it is. I think if you recall from the very first class, we mentioned the cash flow statement, and it was composed of three categories, which are the operating activities, the investing, and the financing activity. We'll see how to classify business activities into the different categories of the cash flow statement, and then we'll see how the cash flow statement is prepared by either of the two methods. However, we are just going to focus on one of the methods that, as I'm going to explain later. Finally, I'm going to show you what is the relationship between the statement of cash flow and the other financial statements. So let's begin by understanding the need of a cash flow statement. So why there was a need for a cash flow statement? Wouldn't the other financial statements be enough? We'll see, especially for the income statement. So if you see here revenue on one side minus expenses, as you know, that this would finally, in a very simple form, would be net income. So let's say that we have 10,000 of revenues and 6,000 of expenses, so our net income would be 4,000. And considering that this 6,000 of expenses could include some accruals, which means that those 6,000 could include some expenses which have never been paid yet, but they accrue means that you deserve to pay them. So let's assume that depreciation expense. This is a non-cash expense. So this means that you're never going to pay this expense. It is, if you remember, it is depreciation expense is debit and accumulated depreciation is credit. Where is the cash? No cash. And that is not going to be paid later. So if there is here, for example, 500, which is depreciation expense, so this $500 of depreciation expense is just an estimate. So here's an estimate, right? There's another estimate, which is the bad debt expense. What about the bad debt expense? The bad debt expense, as you recall, was also estimated. So here we have another estimate. What about the revenue? You know that inside this revenue, there could be also some estimates. So imagine that you took, let's say, $20,000 in advance to do a service. And then at the end of the month, you would come and say, okay, we estimate that 25% of this service is earned. So in this case, you estimated that you had revenue of 5,000. So it is still an estimate. So a lot of estimates are used in revenues and expenses. And hence, this net income would be affected by such estimates too. So the investors are saying, okay, if this net income is based on a lot of estimates like that, how do we guarantee that those estimates are going to come true and at the end we would find this reflected in our cash box? Because if they look at their cash box here and then they find maybe 3,000. So what about the other 1,000? Is it going to be generated into cash or not? So they're not so confident. So they became very actually suspicious about what's the net income, and since then we are supporting the figure of net income statement, which we are going to illustrate in the following minutes.